stock market operation. In that, money market. The money market refers to the market where borrowers and lenders exchange short term funds to solve their liquidity needs. Money market instruments are generally financial claims that have low default risks and maturities under 1 year, and there is a high marketability. Definition: the RBI defines the money market as a market for a short-term financial assets that are close substitutes for money, facilitates the exchange of money for a new financial claims in the primary market, as also financial claims already issued in the secondary market. And also, according to Crowther, the money market is the collective name given to the various firms and institutions that deals in the various grades of the near money market. Features of the money market: the following are the general features of the money market. So, it is a market purely for the short term funds or the financial assets called near to money, and also it deals with the financial assets having a maturity period up to 1 year. So, up to 1 year it has having maturity, and also it deals with only those assets which can be converted into cash readily without loss and without minimum transaction cost. And generally transactions take place through phone, oral communication, relevant documents and written communication can be exchanged subsequently. There is no formal place like stock exchange as in the case of capital market. Transactions have been conducted without the help of brokers. It is a single homogeneous market. It comprises of several submarkets, each specializing in the particular market type of the financing. Example: call money market, acceptance market, bill market, and so on. These are the examples like call money market and also acceptance market and bill money market and so on. The next component of the money market are the central bank, commercial banks, non-banking financial companies, discount houses, acceptance houses. Commercial banks generally play a dominant role in this money market. That are commercial banks, non-banking financial companies, discount houses, and acceptance houses and commercial banks are generally play a dominant role in the market. Objectives: the following are the important objectives of the money market: to provide parking place to the employee short term surplus funds, to provide room for overcoming short term deficits, to enable the central bank to influence and regulate liquidity in the economy through its intervention in this market, and also to provide a reasonable access to the users of the short term funds to meet their requirement quickly, adequately, and the reasonable cost. Importance or functions of the money market: a developed money market plays an important role in the financial system of a country by supplying short term funds adequately and quickly to trade and industry. A developed money market helps in a smooth functioning in the financial system in an economy in the following ways: that is, development of the trade and industry, development of capital market, smooth functioning of the commercial bank, effective central bank control, and also formulation of the suitable monetary policies, non-inflationary sources of the finance to government. These are the functions of the financial market, that is, development of trade and industry, development of capital market, smooth functioning of the commercial banks, effective central bank control, formulation of the suitable monetary policy, non-inflationary sources of the of the government. Money market instruments: some of the money market instruments are as follows, like treasury bills, commercial papers, certificates of deposits, repurchase agreement, commercial bills, call notice money market, interbank participation certificates, and so on. These are all about the money market instrument. So firstly, treasury bills. Treasury bills are the T-bills issued by the Reserve Bank of India on behalf of the central government for raising money. They have short-term maturities with highest up to 1 year. Currently, T-bills are issued with three different maturity periods. That is 91 days T-bills, to 182 days T-bills, 1 year T-bills, T-bills are issued at a discount to face value at maturity. The investors gets the face value amount. The difference between the initial value and face value is returned earned by the investors. That is 91 days T-bills, 182 days T-bills, 1 years T-bills. T-bills are the safest short-term fixed income investment as they are backed by the government of India. Commercial papers. Commercial papers. Large companies and business issues promissory notes to raise capital to meet the short-term business needs known as commercial papers (CPs). These firms have high credit rating owing to which commercial papers are unsecured with the company's credibility acting as a security for the financial instruments. Corporates, primary dealers, PDs, and all Indian financial institutions FIs can be issued CPs. CPs have a fixed maturity period ranging from 7 days to 270 days. However, investors can trade these instruments in the terms of secondary markets. They offer relatively higher rate return compared to that of treasury bills. Certificates of deposits. Certificates of deposits is the financial assets that are issued by the banks and financial institutions. They offer fixed rate of interest or invested amount. The primary difference between CDs and fixed deposits is that the value of principal amount that can be invested. The former is issued for largely sum of money 1 lakh or multiples of 1 lakh thereafter. Because of the restrictions on minimum investment amount, CDs are most popular among the organization than the individuals who are looking to park their surplus for the short term and earn interest on the same. The maturity period of the certificates of deposits range from 7 days to 1 days. If issued by the bank, other financial institutions can issue CDs with the maturity ranging from 1 year to 3 years. Repurchase agreements, also known as repos or buybacks. Repurchase agreements are the formal agreement between two parties where one party sell a security to another with the promise of buying it back at a later date from the buyer. It is called a sell buy transaction. The seller buys the security at a predetermined time and the amount, which also includes the interest rate at which the buyer agreed to buy the security. The interest rate charged by the buyers for agreeing to buy the security is called as repo rate. Repo rates come in handy when the seller needs funds for short terms. She can just sell the securities and get the funds to dispose. The buyer gets an opportunity to earn decent return on the invested money. Commercial papers. A commercial bill is a document that results from the legitimate commerce transaction such as credit transaction. Commercial bills is also referred to as bills of exchange. All the financial institutions, AIFs, non-banking financial companies, NBFCs, scheduled commercial banks, merchant banks, cooperative banks, mutual funds, all issued CBs. These bills have a maturity of 30 days, 60 days, and 90 days. If the sellers need funds, he might prepare a bill and send it to the buyers for approval. The buyers agrees to pay the debts and guarantees to do so by the due date. He might potentially go to his bank and ask them to accept the bill. The bank charges a fee for accepting the bill and guarantees to pay the amount of the buyer's defaults. The vendor can then sell it in the market once the process is completed. A commercial bill becomes a marketable investment in the manner. Typically, the seller will go to the bank to have the bills discounted. Call notice money market. The call notice money market is usually availed for 1 day. If the bank needs funds for more days, it can avail more money through notice market, where the here loan is provided for 2 days or 14 days. Interbank participation certificate, IBPs is yet another short term money market instrument whereby the banks can raise money deploy short-term surplus funds. In this case of IBPC, the borrowing bank sells on the loans and credit that it has in its books for the temporary period to the lending banks. Market for debt issues. Investment in the debt securities typically involves less risk than the equitable investment and offers a low potential returns to the investment. Debt investment by nature fluctuations less in price than stocks. Even if the company is liquidated, bondholders are first to be paid. A market where fixed income securities of various types of securities are issued and traded is known as debt market. Fixed income security includes securities are issued by the central and state government, municipal corporation, government bodies and commercial bodies such as financial institutions, bank, public sector units, public limited companies and so on. Debt or the fixed income securities commonly called as bonds are the fixed financial assets in the hands of the investors that offers a fixed and assured rate of return. And also history of stock markets in India. The history of stock markets in India goes back to the end of the 18th century when the long term negotiable securities were firstly issued in 1850s. Companies Act was introduced for the first time, bringing with its feature of the limited liability and generating investors interest in the corporation securities. The first stock exchange in India was set up in 1875 as the Native Share and the Stockbrokers Association in Bombay. Today it is known as Bombay Stock Exchange, that is BSCA. This was followed by the development of exchanges in Ahmedabad 1894, Calcutta 1908, Madras 1937. It is interested to note that stock exchanges were the first set up in the major centers of the trade and commerce. Until the earlier 90s, the Indian stock market or secondary market comprises regional stock exchanges with the BSC holding the least after the reforms of 1991. The Indian stock secondary market requires three tier form. This consists of regional stock exchange, national stock exchange and over the counter exchange of India, that is NSE, OTCI, regional stock exchanges, national stock exchanges and over the counter stock exchange of India. Next, regulations in India. Indian capital market are regulated and monitored by the Ministry of Finance, the Security of and Exchange Board of India and the Reserve Bank of India. The Ministry of the Finance regulates through the Department of the Economic Affairs Capital Market Division. The division is responsible for formulating and the policies relating to the orderly known as growth and development of the security market, that is shares, debentures and as well as protecting the interest of the investors. In particular, it is responsible for institutional reforms in the securities market, building regulatory and market institution, strengthening investors' protection mechanisms, and providing efficient legislative framework of the securities market. That division administers legislations and rules made under the Depository Act 1996, Securities Contract Act 1956, Security Exchange Board of India, that is SEBI 1992, the regulations or regulators. The Securities and Exchange Board of India, that is SEBI, Security Exchange Board of India, is the regulatory authority established under the SEBI Act 1992 and is the principal regulator of the Stock Exchange of India. SEBI, Security Exchange Board of India, primarily functions include protecting investors' interests, promoting and regulating the Indian securities market. All financial intermediaries pertaining by their respective regulators to participate in the Indian securities market are governed by SEBI regulations, whether domestic or foreign. That RBI, Reserve Bank of India. The Reserve Bank of India is governed by the Reserve Bank Act 1934. The RBI, Reserve Bank of India, is responsible for implementing monetary and credit policies, issuing currency notes, being bankers to the government, regulatory of the banking system, managers of the foreign exchange, and regulatory of the payments and settlement system, while continuously working towards the development of Indian financial markets. The RBI regulates financial markets and systems through different legislations. It regulates the foreign exchange markets through the Foreign Exchange Management Act 1999, and RBI, Reserve Bank of India, controls entire money market. National Stock Exchange rules and regulations. In the role of securities market participant, NSE, that is National Stock Exchange, is required to set out and implement rules and regulations to govern the securities market. These rules and regulations extends to the member registration and securities listening transactions, monitoring compliances of the members to the SEBI, RBI regulations, investors protection, etc. NSE has set rules and regulations specifically applicable to each of the trading segments. NSE has the entire regulatory head by the SEBI, that is Security Exchange Board of India, undergoes the regular inspection by them, ensuring compliances and so on. Corporation and demutualization. Corporation and demutualization, C&D, is a process to change the organization structure of the stock exchange markets from non-corporate and also from mutual firm to corporate demutualization firm, where the ownership, management right and trading rights are segregated. These rights may be held and exercised by the same or different sets of the people depending on the objective of C&D. Next, corporatization of the stock exchanges. The process of converting the organization structure of the stock exchange from the non-corporative structure to the corporate structure is called as corporatization of the stock exchanges. Some of the stock exchanges were established as the association of persons in India like BSE, ESE and MPSE. Corporation of these exchanges in the process of converting them into the corporate companies. Demutualization of the stock exchanges. Transforming the legal structure of an exchange from the mutual form of the business corporation form is referred to as demutualization. In mutual exchanges, the three functions of the ownership, management and trading are linked into a single group. That is, it means that broker members of the exchange are owners as well as traders on the exchange, and further they themselves manage the exchange. These functions are segregated from one another after demutualization. The demutualization stock exchanges in India are the Nationalized Stock Exchange, Over the Counter Stock Exchange, OTCEI and NSE. Organization of the stock exchanges in India. The first organized stock exchange in India was started in Bombay in 1875 with the formation of the native share and the Stockbrokers Association. Thus, the Bombay Stock Exchange is the oldest one in the country, and also the Bombay Stock Exchange, with the growth of the joint stock companies, the stock exchange also made a steady growth. However, many of the oldest company or oldest stock exchanges established on the regional basis have decided to exist. As per the SEBI, Security Exchange Board of India, order passed in 2012, every stock exchanges must have minimum net worth of rupees 100 crore and annual trading of rupees 1000 crores. Many of them found it is very difficult to achieve the target within the stipulated period of 2 years, and hence they have preferred the exit route. As on March 31st, 2016-17, regional stock exchanges have been granted to exist by SEBI. Now, as on December 31st, 2020, the following stock exchanges were working: Bombay Stock Exchange, that is BSE, National Stock Exchange, that is NSE, Metropolitan Stock Exchange of India, INX, India International Exchange, that is NSE, IFSC, NSE International Exchange, and also so on. OTCEI, Over the Counter Exchange of India. The Over the Counter Exchange of India was established in 1990. The Over the Counter Exchange of India was started with the objective of providing a market from smaller companies that could not afford the listing fees of the large exchange and did not fulfill the minimum capital requirement of the listing. Over the Counter of Exchange of India means trading across the counter of in script, and also the counter refers to the location of the members or dealers, and also it is the counter refers to the location of the members or dealers of OTCEI, where the deal or the trade take place. Every counter is treated as a trading floor of OTCEI, where the investors buy or sell Promoters are UTI, ICICI, IDBI, IFCI, LIC, GIC, SBI Capital, and also Market, etc. And features of OTCEI: national wide trading, ringless trading, totally computerized, transparent trading, only authorized dealers can trade, faster transfer and trading of shares, investors registration is necessary. And also Bombay Stock Exchange, that is BSE, it is only Indian stock exchange established in the pre-independence era 1875 and was instituted as the native shares of the End Stockbrokers Association. BSE has an operational speed of 6 microseconds, making it one of the fastest stock exchanges. It facilitates the trade to trade in multiple financial segments like equity, currency, debt instruments, mutual funds, and also derivatives. And also, it lists different companies on the basis of index called as Sensex. Sensex consists of 30 companies that are performing well and as well as actively traded in the stock market. Presently, around 5,000 plus companies are listed in BSA, and maximally are approximately 250 small and medium enterprises. There are three segments in BSA. They are equity segment, debt segment, and derivative segment. Objectives of the Bombay Stock Exchanges are establishing a national-wide trading facility and transparent and market for trading in equity, debt instrument, derivatives, and mutual funds, ensuring equal access to all investors across the country through an appropriate network, providing fair, efficient, and transparent security market using electronic trading system, enabling shorter settlement cycles, meeting international standards. And also next, NSE, National Stock Exchange. It is popularly known as NSE, National Stock Exchange, and is one of the India's biggest stock exchange based on the market capitalization. And also its establishment of NSE is a step to overcome the deficiency is of the existing stock market and also bring Indian financial markets in line with the international markets. It was founded in 1992 but started operating in 1994, and it was started with the equity capital of 25 crores and promoted by IDBI, ICICI, LIC, GIC, and also its subsidiaries State Bank of India and also SBI Capital Market Limited. It began electronic scheme-based trading in 1994. It offered trading in equity and also wholesale debt market segments. And still today, it has the option to trade in the derivative mutual funds, equities, IPOs, ETFs, exchange traded funds, corporate bonds, debt market, and many more. It became the first exchange in India to do so by launching the facility to trade in derivative. It also started electronically traded in the year 2000. Currently, approximately 1,700 companies are listed on the exchange, of which around 1,370 are active. Similarly, to the Sensex, NSE index is called as Nifty, and that enlists the 50 most are actively traded companies. Trading in the indices open the gateway to earn a good profit and to plan the best stocks for long-term investment. However, companies listed on NSE are necessitated to fulfill some of the essential criteria to become eligible. Only companies that satisfy the eligibility requirement to stay listed on the exchange. Even companies that after getting listed fail to meet the eligible criteria are unlisted. Objectives of NSE, National Stock Exchange, to establish a wide level trading facility for equities, debt, and hybrids, to facilitate equal access to the investors across the country, to provide fairness, efficiency, and transparency to the security trading, to enable shorter settlement cycles, to meet the international securities market standards. So it is nothing but it established national-wide trading facility for equities, debt, and hybrids, and also access to the investors across the country, and also fairness, provide fairness, efficiency, and transparency. So there would be a transparency to the security trading while trading, and also enable short-term settlement cycles, and also to meet the international security market standards. So as per the marketing standards, it will act. Nextly, we will move on to the SEBI, that is Security Exchange Board of India. It is established in the year 1992. SEBI is a watchdog of the stock exchange activity, and also it aims at the regulating and controlling the working of the stock exchanges, and it deals so as to protect the interest of the investors. Objectives, according to preamble of the SEBI Act, the primary objectives of the SEBI is to protect or promote healthy and orderly growth of the securities market and secure investor protection. For this purpose, the SEBI monitoring the activities of the not only stock exchanges but also market merchant bankers. The objectives of SEBI are as follows. These are the objectives. Some of the objectives of the Security Exchange Board of India are to protect the interest of the investors so that there is a steady flow of the savings into the capital market, and to regulate the security market and ensures fair practice by issuer of the securities so that they can raise resources at minimum cost. And also third one, to promote efficient services by brokers, merchant bankers and other intermediaries so that they become competitive and professional. And also the functions of the SEBI, Security Exchange Board of India. As per section 11 of the SEBI, that is Security Exchange Board of India Act, specifies the functions as follows. Regulatory functions, regulations of the stock exchange and self-regulatory organization, registration and regulations of the stock brokers, sub-brokers, registrars, and to all the issues, merchant bankers, underwriters, portfolio managers, and such as other intermediaries who are as follows associated with the security markets, registration and regulations of the working of the collective investment schemes, including mutual funds, and also prohibition of the fraudulent and unfair trade practices relating to the security markets, and also prohibition of the insiders trading in securities, and also regulating substantial acquisition of the shares and takeovers of the companies. Secondly, developmental functions, promoting investors' education, training and intermediaries, and also conducting research, and also publishing information useful to the all market participations, and also fair practice, that is nothing but promotion of fair practices and code of conduct for self-regulations organization, and also self-regulatory organization, that is for promoting the self-regulation regulatory organizations. And this is all about the financial markets, and also capital market and money market and so on.